But what about the housing market? How will the housing market be affected by rising interest rates? Well, if we look at the Fed charts, we can look at the Case-Shiller index in blue here and the interest rates again in red. And you'll see a very clear trend, which is that the housing prices have been increasing as interest rates have been decreasing. So there is a strong correlation between the interest rates and housing prices. However, you'll see that housing prices are not nearly as sensitive to interest rates. If we look at these periods here, you'll notice that the interest rate spiked, but the housing prices more or less continued uninterrupted up. But there's an exception to that rule, and that was in 2008. Here you can see interest rates spiked and housing prices did come down. And I believe the reason for that is quite simple. We had been coming from a place where the interest rates were near zero, under 2.5%, and then we spiked it over 5%. And what that created is it created a lot of stress on lenders. You've all heard of the mortgage-backed security crisis, and that was when people were buying houses on loans but didn't really have good credit. So as interest rates increased and they could no longer service their debts because they weren't creditworthy, they had to liquidate their assets, and that's why housing prices fell. In 2018, we had another interest rate spike, but it never crossed 2.5%, which meant that interest rates were essentially still zero, and that's why we didn't see any response in housing prices. But now interest rates have risen from essentially 0 to 5%, which is a huge increase, and we're seeing that pressure on homeowners and commercial real estate.